from the beginning of the year, the interest rates were actually going up. Not all banks adjusted their rates upwards because, again, banks are competing. So it's not just an issue of increasing the rates, because you can increase the rates and then now be able to mark yourself out of the market. So there are some banks, deliberately, they maintained their interest rates to compete in the market as the interest rates were going up. Now, those banks are in a dilemma even currently. Now when they are coming down, we are being asked to come down. And yet when you're going up, we never went up. We actually took a hit just to be able to remain competitive and then also take consideration of our customer. Because they were feeling that, yes, we increase, the customer fails to pay, it goes to non-performing loans. So that's the dilemma that there is in the market. That's why you'll see it's not uniform. For February MPC, there are banks who have moved 0.3%. There are banks who have moved 3%. So if you look for a bank that has moved 3%, you may find when it was going up, they moved up by a slightly higher margin. So they're able to make a slightly higher margin coming down. But for a bank which remained, it was at 16, it's coming down, then we're asking the bank to still come down. You may find that that's why there's this variance, in that you'll find some banks have moved 0.5, others have moved 1, others 2, others 3%.
I may not have the advantage of the whole conversation, but I was following the discussions. But in the last 1 or 2 years, we've never had the CPR rate go beyond 14%. So even the argument that then these banks they never adjusted the interest rates downwards and they actually took a hit, I don't think that is really factual. It's actually misleading, because in any case, we've never had interest rates the CPR rate go above 14%. And if you follow the law, and then that should be at least at most 4 percentage points, then the highest should have been at 18 at any particular time, which is what is there with most banks now. So do you really want to say that as a statement of fact?
Yeah, typically, maybe I can use an example for purposes of demonstrating this in terms of assuming the CBR has moved consistently. I think it moved all the way to 13% last year. As the highest that we 13.
So 13 plus 4 percentage points, then the interest rates should not have gone anywhere above 17. The average now, as per the report of Central Bank, is 16.4. So it means that the average is way higher than even when the interest rate was the highest at 13%.
Yes, because there is a risk margin that is loaded onto it, and maybe so that I answer the question around whether capping is an option.
Before you go there, Chair, with your permission.
Yes, I'm coming.
The question before you go to capping, because we are looking at solutions around this one issue. You've been told that the Monetary Policy Committee set the current rates over 30 days ago. And the law you referred to speaks to the banking industry being able to act within 30 days. We need an explanation for that, and the penalty we preferred for the non-compliant banks.
Yeah, so
maybe meant to help you. The last MPC meeting was on 8th of February. Okay? So 30 days from 8th of February would be on and about 8th of March. Today we are on the 25th of March. So between 8th of March and 25th of March, how many days later? 17 days later.
yes.
So then you are clearly in breach of the law, and you're justifying how you're in the breach of the law.
Let me explain, Chair.
Hold on. You have a chance.
I would also want to understand how the risk margin is determined. Because besides that, there's a risk margin. Is it on personal or on individuals, or the rate is common across the board.
Yeah, but now, again, I was following the conversation, and the answer was that different banks have different ways of determining the risk factor. And anyway, but I'm not attempting to answer your question. Responding to
that's why Chair had asked earlier that could we be in a situation where we are supposed to legislate over this risk issue, because it might be misused. Thank you.
Thank you very much. So respond to the question about the risk factor and why it has to be different with different banks, and whether you think that then the best way to have a uniform. And we're asking you as a representatives of the banks, because we're not here to, we are here to try to understand your business, and so that we both protect the business and most importantly protect the consumers of the business. That's why we are here as the representatives of the people. So answering that perspective, and the question about 1 month after the MPC. And maybe just a follow-up on that MPC. We have the next MPC meeting in 8th of April. So if you've not acted on what the last MPC resolved, and you have another MPC coming up in 2 weeks, then, actually in a week, then are you really being responsive to the decisions made and to the directive given by your regulator, which, which is your license, the Central Bank of Kenya?
And maybe, Chair,
yes, CPA?
as they are responding particularly to that, can they confirm that CPK has intervened on this matter, has engaged them over this issue? Could they confirm? Because from the way we are talking, it looks like the regulator is talking his own things, and the bankers are doing on their own. Could they confirm?
Please respond.
Yeah, maybe I'll start with the easier one. Yes, CBK has engaged the banking industry on the same and continues to do so.
And up to now, we are that the MPC is about to take place without implementing the recommendation resolution of the first MPC. So what is happening?
Yeah. So on the question of MPC having met on the 8th of February, and 1 month now lapsed on the 8th of March. So banks did adjustments on their lending rates and communicated to customers as required by the law and the practice. So the numbers for March are yet to be published. That would now show the adjustments that have been effected. Because the numbers for March are yet to be published, what we did as an association was to call our members and ask them, to what extent have you made adjustments aligned to the monetary policy reduction in the central bank rate? And they gave us a range that, because all of them are applying different models, they have from 0.37% to 3% has been affected. And when we look at the average, it was coming to about 1.65%. So that is what has been applied, and it would be reflected within the lending rates for February, as well as also the lending rates for March, because that announcement was in early February. It would be affected within February and March. So those numbers, when they actually come out, it should reflect the rates that were affected. So with another adjustment coming in April, again, we see that being implemented in the days after April for purposes of just making sure that there is transmission. So for sure, when the numbers get published for March, we will actually see a reduction in the lending rate. And I think so far the number, though yet is to be published for lending rates, they've actually come down. We had in January 16.64. They've actually also come down to about 16.41 in February, and is expected even to be transmitted stronger in March, because that's when now the 1 month lapse of the notice period would actually have taken root. So by all means, we will see lower rates in March when the numbers actually get published. The other element that I think is important for us to explain is there is usually, typically in any economy, it's never uniform. when rates are going up and when they are coming down. That is in any way, in any economy. And this is even demonstrated from the numbers that we have for deposit rates and lending rates. The adjustments usually are never the same. Look at it this way. When rates are going up, those that have fixed deposits in banks start to factor in very early. And they actually approach banks and say, you're giving me, I was giving you my deposits at 8%, but CBK rate has moved up. So there's anticipation that rates would go up. They're even willing to break a fixed deposit to contract it at a higher rate when rates are going up, because there is an incentive for it to do this. And they can even argue and say, all rates are going up, government security rates are going up, so policy rate has gone up. Now, there is pressure on the side of bank to reprice the deposits, because the depositors want a higher return because they can factor in the changes in the market. When the things turn, the depositors would even want to delay their loans that they had fixed for a longer period of time, for longer, because now rates are going down. No one wants to cut or break a fixed deposit, and that in itself, for as long as deposit rates remain high, there would be rigidity on the part of lending rates to also move down, and that's why you see them moving down slowly. When you look at the numbers that we have given on table 1, page 2, we have deposit rate changes, lending rate changes. Just take the example of November to January. Deposit rates, when rates were moving down, deposit rates moved from 10.41 to 10.05, a change of 0.36. Lending rates moved down from 17.22 to 16.64, a movement of 0.58. So banks have actually effected even a higher adjustment on the lending rate compared to the cost that they have to bear for deposits. So in essence, banks are doing the transmission of monetary policy. There is pressure, however, on the side of the cost of deposits that are not adjusting as fast. And I think Raymond, our CEO, did mention the pressure, competition for the same fund, because depositors are saying, government securities is giving us this. How much more would you give us for us to retain the fund within the bank? And typically, definitely, for a bank to be able to continue lending, they have to continue mobilizing the deposits. There's a cost to that. So we look at all those rigidities, that pressure that is not uniform when rates are going up compared to when they are coming down. There is the notices and accommodations that we have to give to customers. The 30-day notice period was really a consumer protection issue, particularly when rates are going up. It looks good, and I can bet with you, 30 days looks short when rates are going up, but looks very long when rates are going down. That's the asymmetry that we typically see. On the considerations where we are in terms of pricing, we had interest rate capping implemented between 2016 and 2019 when they were repealed. During that window, credit growth never went beyond 10%. And it's because if it is capped, it means then a risky customer who would be priced, say, we are now moving fully into risk, moving fully pricing environment. Each customer would be able to access credit at a risk profile that each bank does on them. So as a result then, we actually started seeing credit growth. It went all the way to 12%, 13%, and we started seeing stronger growth in credit that was able actually to support economic activity during that period. And I think numbers are there to demonstrate that. During the period when interest rate caps were in place also, because now the funding of private sector was limited to those that had good credit profiles, there was a lot of investments in government securities by banks as a result, because then the room in the private sector